Gautam Trivedi, Managing Director and Head of Equities with Religare Capital Markets, joins us live. Gautam, morning. Thank you for joining us. What is on your radar this Wednesday morning?
Yeah, I think we are looking at a host of OFSs over the next 2 days, or should I say over the next few days. More importantly, because I think you have almost 12 tomorrow, about 3 to 4 today. And I think a lot of people are going to be focused on how the market's going to react to a raft of OFSs and slash IPPs, and the target being 15 to 20,000 crores over the next few days will indeed suck out a lot of liquidity from the system.
What about rupee? Is that a concern, or do you think as of now one can safely ignore all the movement in currency because the underlying momentum is strong and could see global liquidity, markets will ignore the currency movement?
See, I think the currency movement, as much as obviously every time the rupee does depreciate, it's a cause of concern. But this time around, it's not been led so much by the trade deficit and the BOP numbers. It's been led more by the yen movement. And if you look across the board, year to date, or even over the past month, you will see that most major currencies in the world have depreciated against the dollar. So I don't think we are an exception, and I'd be surprised I would have been very surprised had we been an exception anyway. So I think it's more to do with the dollar strengthening rather than the BOP or the fiscal situation this time around.
So what is the right thing to do in this market? Should one focus on global equities? Should one focus on US equities, developed market equities which are holding on? That is the mother market, and if the mother market is holding on, equities as an asset class will be in some kind of an uptrend. Is that the right approach?
I think that is very much the right approach. The fact is, liquidity is clearly awash right now. If you just look at the numbers, which are staggering, we have seen year to date $14.5 billion of absolute FI flows coming into India. That is up more than 70% year on year. So that's a staggering number. If you look at the liquidity in general that's coming into Asia, not just India but also the ASEAN markets, Japan in particular has been a big magnet for liquidity this year. You've seen a total of $80 billion into Japan this year. That's up 600%. So I think money is obviously finding its home, and frankly, had our house been in order, i.e. better fiscal, better earnings, and a better interest rate environment, I think India could have brought in a lot more money than what we've already seen.
Gautam, with the assumption that interest rates may come down and the market actually running up somewhat on account of that as well, do you think it's somewhat overplayed? Because barring inflation, the current account deficit, crude prices, commodities may not actually lead the RBI to cut rates as much as the market has assumed so.
Well, I think there always are two opinions about anything for that matter, and the fact is, we believe that the RBI will potentially cut another 25 basis points and a total of another 75 before the end of the current fiscal. So I think we continue to remain bullish about the fact that the RBI will cut rates and inflation will remain benign. I think that has obviously been the other reason why India has been able to attract so much money. So I think we are obviously a commodity sensitive economy, and until that doesn't change, every spike in commodity prices will obviously hurt our flows as well as the economy, and vice versa.
Gautam, there is an argument on the street that markets are running on steroids, and once the effect of steroids will run out, reality will set in.
Well, I think I don't want to comment on the word steroids, but the fact is the market clearly is at this point running on global liquidity. It's not on domestic fundamentals. We haven't really seen a significant turnaround in any of the fundamentals. I frankly haven't seen any major green shoots either that would basically help me conclude that the economy is starting to actually turn around. So I think let's be practical about that on the domestic front. On the fund flow side, if you look at the domestic fund flow side, every time the market crosses 60, the Nifty crosses 6100, you see retail investors coming out to redeem with the mutual funds. So unfortunately, the redemption pressure both at the domestic mutual funds as well as insurance companies, where the ULIPs are maturing, continues unabated. That is one. Two, if you look at the India dedicated offshore funds, long only offshore funds, with the exception of one or two, the rest of them are not seeing, unfortunately, any inflows. So I think if you even look at that side, there isn't that much money coming in. So the money really is coming in through ETFs. It's coming in through regional fund allocations. So a lot of the global fund managers who manage India dedicated money are not seeing any inflows into their own funds. However, they are advising their regional funds to put more money to work in India. So we're seeing a bit of that. But outside of that, I think the domestic situation remains clearly not favorable as of now. We haven't seen a great turnaround in the results declared so far either. So I think, I wouldn't use the word steroids, but frankly, this is global liquidity at this point.
Gautam, so where do you think money is going to park itself? Would it be the spaces which have already looked good, for example, banks, which have seen a fair amount of run-up? Or do you think money is going to come into beaten-down pockets like a capital goods, which has been bouncing its head in the last couple of trading sessions?
Yeah, I think that's a good question, because if you look at year-to-date, bulk of the money has come into consumer, healthcare, and some IT. Now, IT, unfortunately, has now gone into a pause mode given the U.S. immigration bill, and there's a lot of debate out there. I mean, for example, last week we were talking about and recommending Satyam and Tech Mahindra as one of our top picks, given the valuations are very attractive, 8.5 times forward earnings, 30 to 40% discount to the Big Four. Unfortunately, there were not too many people who were interested in listening to that story, simply because they said, with the U.S. immigration bill, we've just basically put all of our IT investments on hold, and we would actually hold back putting fresh money to work. So that takes care of, the IT space for the time being. So it's been mostly, I think, consumer and healthcare that you've seen bulk of the money coming in, which tells you it's been mostly a defensive rally. Even now that the money that I see coming in from a handful of long-only investors, and we all know who they are, that money still continues to go into the levers and the ITCs or United Spirits. So I think that's really where you're seeing bulk of the interest at this point. Cap goods, we're probably a couple of quarters away, not more rather, and I hope, from a turnaround. So one of our top picks in the cap goods space is Crompton Greaves. The stock has seen a low in the 80s, and now it's at about 95, 96. And we do like that stock, but I think clearly that story also will take a couple of more quarters before it starts to unfold. We're still very positive on the name, and we have about a 50% upside, but the fact is, there is still limited interest in the cap goods space at this point.
You talked about United Spirits. Is there still scope to get into the stock and make money, or has one missed the boat?
I don't think you've missed the boat, but I think, given the surprising U-turn in that stock, I mean, I wouldn't say U-turn, but, the stock had stalled at about 1800 over confusion about whether, the Diageo offer would fail and, what would happen with Mr. Malia's holdings, which were pledged. But obviously the stocks, run ahead of all of that. At these levels, at 25, 2600, I'm not sure how much more upside really is left. Of course, there's an article yesterday on Bloomberg which spoke about potentially a stake sale in one of White and McKay's Scottish properties. Now, if that were to happen, of course, that would unleash another $500 to $1 billion of money into United Spirits. And again, it's pure speculation at this point, so I don't know if it's necessarily true. So, I mean, there's upside if the asset sales were to pick up, but if they don't, I think the stock's fairly valued at this level.
Gautam, so at a time when central bankers are committed to print money, equities as an asset class is making a comeback. Money managers, they want to buy stocks, but they want to buy into quality stocks. Do you think the right thing to do in this kind of an environment is to stick to quality? Because none of those value arguments have made money in last 1 year.
Yeah, that is true. And I agree, the last 12 months you really haven't made significant money in value propositions, or even for that matter, mid caps. But, the question one needs to ask really is, how far are you from a real turnaround? And if we are, again, we could have had the same conversation same time last year, and we both would have been wrong. But if we are truly, in a situation where inflation is benign, interest rates are coming down, and, of course, we do have 12 months to go before the next election. But the next government comes into power, whoever it is, ends up, even if it's the same government, but with a renewed focus on improving the economic health, with, Mr. Chidambaram in the role of the finance minister or something more senior, I think we are not then necessarily too far, from being in a turnaround situation. So, there are times when you look at some of the mid caps and say, wow, these are really trading at cheap valuations. Should I accumulate these from a longer term basis? I think some of these mid caps do look attractive, and frankly, I think now would be a good time to start looking at them.
Is it worth the risk? Because those who bought Crompton, BHEL, L&T, Thermax with the hope of turnaround, that turnaround is not visible.
Yeah, I agree. So that's what I'm saying. The last 12 months, would have been a bad idea to have bought cap goods, and I'm hopeful, and I guess as a lot of us are, that the worst is behind us, and we end up hoping to see a turnaround over the next 12 to 18 months of the economy. So if that's the case, some of these stocks are pretty attractive. In fact, Cummins is one of our top picks as well, besides Crompton Greaves in the cap goods space.
What is the best way to approach banks? Because PSU banks clearly have not conducted themselves very well for the quarter gone by. The management commentary from PNB or State Bank of India was not that constructive. Private banks are expensive. So what are the options left?
See, it's like this. I think as far as PSU banks are concerned, PSUs are clearly a trading, most of the foreign institutional investors actually prefer to trade these stocks versus actually buy them from a fundamental long-term basis, which is unfortunate, but I mean there are multiple reasons for that. So we've, over the past 2 quarters, we did put out several notes on buying PSU banks from a long-term basis, but the fact is, with the exception of some of the local fund managers, most of the FIs had pretty much zero interest in putting money to work from a long-term perspective on PSU banks. So if you have a State Bank of India which is currently trading at 1 times price to book, 15% ROE, and you have an Axis Bank also at the same ROE, but at a 1.8 times price to book, which would you rather buy? I think I'd rather put my money on State Bank of India. So I think that's the way to approach the PSUs. And I think in terms of privates, the investment community continues to believe in the private story. Continues to want to buy the HDFC banks, Yes banks, IndusInd banks. I think that doesn't change. So I think that would be my approach as well.
Gautam, I'm getting an increasing sense that now market men are revisiting mid-cap FMCG names. So if you look at the price action in Emami, if you look at the price action in Dabur, followed by Britannia, these stocks have done rather well in last 1 month. Do you think that is one space you would like to associate yourself with? Look, go down the ladder, ignore the levers and the ITCs for the time being?
Yes, I would, because I think if you look at the valuation of, let's say, a lever, for example, it's at 35 times next year's earnings. It's very expensive. It's not cheap anymore. And if you look at the overall top-line growth of the FMCGs for the fourth quarter that just ended, you've seen a top line of anywhere from 12 to 15%. So, we're still talking pretty healthy double-digit top-line numbers. And in spite of what, of all that people said, the numbers actually have been fairly good. 1, 2, if you have the food security bill and or another form of Narega being passed by the UPA government prior to elections, you will see a significant improvement in the overall consumption in the tier 2 and tier 3 towns, rural economy as well. So all of that's, I think looks still pretty positive for the FMCG names, and given the valuations are of the large caps, I'd prefer to buy the Imamis, clearly.
Gautam, let you go on that note. Really appreciate you taking the time out and joining us on the show.